On his very first day, the newly appointed Fed chair was stabbed in the back by his own people. Trump painstakingly selected someone to cut interest rates. For the first time in 39 years, the Federal Reserve Chair's inauguration ceremony was held at the White House, with Trump personally endorsing him. A Supreme Court justice presiding and the Treasury Secretary present, it was as if he wanted the whole world to know, "This is my guy. The era of interest rate cuts is here." Yet before he could even warm his seat, his colleague Fed Governor Waller, at a forum in Frankfurt on the same day, said to global investors, "You cannot look at this data and seriously say we can cut rates in September. As a central bank official, you cannot say that." On the same day, one was sipping champagne in the White House, the other was dropping bombs in Frankfurt. Gold is currently stuck at $4,561. Neither moving up nor down, not because there is no direction, but because the Federal Reserve is fighting its fiercest internal battle in 39 years. In this video, I will explain this situation clearly, tell you why gold is stuck here, why a set of data this Thursday might directly decide whether gold surges to 4,700 or crashes to 4,300, and a 0.7% data difference that insiders are discussing, but you likely do not know about. This data difference is the real flashpoint. Okay, back to the main topic. What did Waller say? He said the Fed should remove the easing bias wording from its policy statement. In plain terms, this means no longer assuming that the next step is a rate cut, and that the probability of a rate hike and a rate cut should be equal. He also added that the direction of inflation is wrong. Waller is not some fringe figure. He is one of the most influential governors within the Fed and was previously considered dovish. He even supported a 75 basis point rate cut by the end of 2025. If even such a dovish person has turned hawkish, what do you think the new chair faced when he walked into that meeting room? Not a group of colleagues waiting to cut rates with him, but a group of opponents sharpening their knives, ready to raise rates. The last FOMC meeting saw 4 dissenting votes, and the direction was still split. Some wanted to be more hawkish, some more dovish. This was the most split vote since 1992. Moreover, Powell announced he would remain a governor and not resign. This 14-year Fed veteran. The former chair is sitting right next to the new chair. He said there can only be one chair at the Fed, and once the new chair is sworn in, he is that chair. But he also said something else. "I am waiting for that investigation to conclude." He was referring to the criminal investigation initiated against him by Trump. This means Powell will remain in that seat, and his vote could be the deciding factor at a critical moment. The CNBC report headline was straightforward: "The new chair walks into a family feud." The latest data from CME FedWatch shows that the probability of a rate cut in June is close to 0, and the probability of a rate cut this year is less than 10%. The person sent by Trump to cut rates walked into a room where rate hikes are being discussed. This is the biggest contradiction in the gold market right now, and the true meaning behind the $4,561 price. But you think this is all far from it. To understand where gold will go next, you must understand the thinking of the new chair. Many analyses only focus on him being Trump's appointee, which is too superficial. The new chair comes from a background as a Morgan Stanley investment bank executive, became a White House economic advisor in his 30s, and at 35 became the youngest governor in the Fed's history. He experienced the entire process of the 2008 financial crisis and was a participant at the decision-making table during that crisis. He is not an ivory tower academic. He emerged from the gunfire of Wall Street, but more importantly, his belief. The new chair has long advocated the view that low interest rates and high growth are not mutually exclusive. He believes that relying on technological progress, productivity improvements, and supply-side relaxation can absorb inflation in a low interest rate environment, while simultaneously promoting sustained economic prosperity. Does this theory sound familiar? Indeed, this is the new economy golden age theory that Greenspan became famous for in the 1990s. So when the new chair said at his inauguration that he wanted to build a reform-oriented Fed to learn from past successes and failures, and to break down rigid traditional frameworks and models, the first name that came to mind for insiders was Greenspan. This is not just because they were both sworn in at the White House, not just because they both faced soaring oil prices and inflationary pressures when they took office, but more importantly because their underlying beliefs are astonishingly consistent. Greenspan back then believed that information technology could bring about a leap in productivity and specifically used large computers for economic modeling. He himself was a direct beneficiary of information technology development, and the new chair explicitly stated in his hearing that he believes the revolutionary impact of AI on productivity is no less than another industrial revolution. They even faced the same political situation. Back then, Reagan desperately needed a successor who could maintain an anti-inflation stance while being willing to loosen financial regulations. Greenspan was that person today. Trump desperately needs someone who can cut interest rates to revive the economy and will not publicly contradict the White House. The new chair is that person. Greenspan, in his early tenure, had to prove to the market that he was not a puppet of the White House. The new chair faces the same problem today. The 55-45 Senate vote was the lowest approval rate for a Fed chair in history. Democratic Senator Elizabeth Warren directly called him Trump's puppet. The circumstances of their appointments are almost a replica. And what path did Greenspan later take? In the mid to late 1990s, the U.S. economy was strong, the internet was booming. Greenspan warned of irrational exuberance in 1996, but the market did not listen and continued to surge. At the same time, oil prices continued to climb, increasing inflation concerns. In 1999, he raised interest rates 6 times in 1 year, from 4.75% to 6.5%. The result was that by the end of 2000, consumption and manufacturing orders declined, and the internet bubble burst. Then came 9/11s. The Fed, from January 2001 to June 2003, cut rates from 6.5% to 1%, with multiple large rate cuts. It was not until June 2004 that they began to raise rates again. And it was those years of ultra-low interest rates that caused money to pour into real estate across the U.S., laying the groundwork for the 2008 subprime mortgage crisis. After retiring, Greenspan personally admitted in a congressional hearing that his lifelong creed that financial institutions could self-regulate and free markets could perfectly self-adjust had flaws, and the scale of the financial crisis shocked and disbelieved him. The new chair said at his inauguration that he would learn from successes and failures. The success was Greenspan breaking the framework and accurately predicting the miracle of technology revolution on productivity. The failure was the 2 bubble bursts caused by long-term low interest rates coupled with excessive trust in market self-regulation. There is a saying on Wall Street called Greenspan put, meaning that every time the market plunges, Greenspan would step in to backstop it. If you win, it is yours. If you lose, old Greenspan is there. This psychological hint greatly fueled speculation and excessive risk-taking. Can the new chair avoid repeating the same mistakes, or will he, under the political pressure from the White House and the greed of the market, gradually slide into another unpredictable macroeconomic bubble? The answer to this question lies in the price of gold. The new economy belief of the Greenspan era created the internet bubble. What will the AI belief of the new Charis era create? The pricing of gold is essentially answering this question. Okay, the story is over. Now back to the market. Gold is currently trading between $4,561 and $4,580 from its historical high of $5,595. On the 29th of January, it has retreated by about 18%. In early May, it once fell to $4,560, the lowest point in 5 weeks, but it did not crash. Instead, it has been oscillating within a wide range of $4,300 to $4,840 for over a month. On the fundamental side, the 200-day moving average at around $4,300 provides strong support, and the 50-day moving average at $4,740 forms dynamic resistance. Last Friday, it closed at $4,523. After the Asian market opened on Monday, it jumped to the $4,561 to $4,580 range, right in the middle of the box, neither up nor down, with bulls and bears at a stalemate. Why is it stuck here? Because both longs and shorts have live ammunition, and neither can kill the other. On the long side, global gold ETFs recorded net inflows of $6.6 billion in April, ending the record $12 billion outflow. In March, Asian funds continue to enter the market to buy on every dip, showing very firm conviction. At the end of April, total global gold ETF holdings reached 4,137 tons, just a breath away from the historical record of 4,176 tons set on the 27th of February. The largest gold ETF in the U.S. also recorded net inflows of $830 million in April, narrowing the cumulative outflow since the beginning of the year to $1.5 billion. State Street clearly stated in its May report that the $4,000 support level holds even in a bear market scenario. On the short side, the 10-year U.S. Treasury yield remains around 4.34%, the highest level since 2007. Although the U.S. dollar index has retreated from its early year high, it is still firm at the 98 level. The CPI soared to 3.8% in April, the highest value since mid-2023. The CME FedWatch tool shows that the probability of no rate cut this year is as high as 60%, and the net long positions of managed money in COMEX decreased by 4% in April, with retail positions also being reduced. Speculators in the futures market are fleeing. On one side, large funds from ETFs are buying the dip, while on the other side, speculative players in the futures market are leaving. This divergence historically often means one thing: the market is brewing a directional breakthrough. The question is, in which direction? The answer is not in technical charts, but in this Thursday's data and in the new Chair's mind at 0.7%. A market at a stalemate is never the end point. It is just the silence before the storm. 4,561 is not a price. It is a ballot. You are voting with real money, betting on whether the new chair will win or Waller will win. Now, I am going to talk about something that insiders know, but outsiders almost ignore. This thing could be the most critical variable for gold's trend in the next 3 to 6 months, but almost no media has seriously discussed it. On the 21st of April, The new chair said something seemingly bland but extremely significant at a Senate Banking Committee hearing. He said he does not fully trust the Fed's own inflation indicators. What does this mean? The Fed's currently officially used inflation indicator is core PCE, which is the Personal Consumption Expenditures Price Index. The latest reading of this indicator is 3.0%, but the new chair tends to use another indicator, the trimmed mean PCE released by the Dallas Fed. What this indicator does is simple. It removes the items that rose the most and fell the most each month, only looking at the middle part, thereby filtering out short-term noise. The current reading of the trimmed mean PCE is 2.3%. The difference between 3.0% and 2.3% is 0.7 percentage points. You might think, what is the big deal about 0.7%? This 0.7% is the dividing line between cutting rates and not cutting rates. If the Fed looks at the 3.0% core PCE, then inflation is still 1 percentage point above target. And a rate cut is out of the question, but if it looks at the 2.3% trimmed mean PCE, then inflation is very close to the 2% target, and the door to a rate cut opens. What the new chair wants to do, in essence, is to change the thermometer. If you have a fever and you change to a thermometer with a lower reading, you do not seem to have as much of a fever, but the key is that this is not a deception. The trimmed mean PCE is widely recognized in academia. The Dallas Fed's research team has repeatedly published papers demonstrating that it is a better measure of underlying inflation. So the new chair has ample academic ammunition to support this replacement. Goldsilver.com published a special analysis at the end of April titled How the New Chair's Inflation Measure Could Impact Gold Prices. It clearly explains this logical chain. If the new chair governs according to the trimmed mean framework, the path to rate cuts is clear. Lower interest rates compress real interest rates, and falling real interest rates are the most fundamental structural positive for gold. Now, looking back at Waller's remarks in Frankfurt, he said that the direction of inflation is wrong and that rates cannot be cut. His reference frame is the official 3.8% CPI and 3.0% core PCE. But if the new chair successfully replaces the reference indicator with the 2.3% trimmed mean, Waller's logic loses its foundation. You see, with a different thermometer, your judgment of the patient's condition is completely different. So this is not a debate about whether to cut rates, it is a power struggle about which thermometer to look at. And the first formal battleground for this struggle is the new chair's first FOMC meeting on the 16th of June -17. That meeting will release updated economic projections and dot plots. If the new chair at the press conference even just mentions the trimmed mean PCE or hints that inflation might be overestimated by current indicators, the market will reprice rate cut expectations within hours. Gold could directly surge to 4,700 or even higher. Conversely, if he chooses to concede at the first meeting and completely follows Waller, the market will conclude that the dream of rate cuts is completely shattered. Gold prices could retest 4,400 or even 4,300. Some might ask, is not the new chair, the chairman, can he not just cut rates if he wants to? As mentioned earlier, he only has one vote. He faces the most divided FOMC since 1992, and Powell is sitting there watching the chairman. Power is no longer in voting, but in setting the agenda and guiding the discussion. But if the entire committee does not buy into your agenda is just a piece of waste paper. 0.7% is not just a number, it is a key. Whether the new chair can use this key to open the door to rate cuts will determine whether the gold you hold rises or falls. Speaking of this, I want to introduce another industry figure, Robin Brooks. He is a senior researcher at the Brookings Institution and became famous last year for accurately predicting the Japanese bond crisis. In early February this year, when the news of the new chair's nomination just came out, Brooks published a widely circulated analysis. His core conclusion was very aggressive. The new chair would collectively cut rates by 100 basis points at the 4 FOMC meetings in June, July, September, and October. His logic is simple. The new chair believes that the U.S. is in a high productivity, low inflation equilibrium state, so current interest rates are too high and need to be reset as soon as possible. A deeper consideration is that the new chair is most afraid of Trump turning against him like he did with Powell. So he will complete the rate cuts before the November midterm elections to provide a buffer for the economy and the election. Brooks' original words were this: "I do not believe this productivity story, but I can see how it will be used." Notice this sentence. A top economist, he does not agree with this logic, but he believes this logic will be used to cut rates. What is this called? This is an open conspiracy. If Brooks is right and interest rates fall from the current 3.5% to 3.75% down to 2.5% to 2.75%, the dollar will weaken, real interest rates will fall, and gold will be the biggest beneficiary. This is why when the news of the new chair's nomination first came out, although gold prices briefly fell by 5% due to hawkish panic, they quickly recovered, because smart money was positioning for rate cut expectations. However, Brooks' forecast was made in February. Since then, the world has changed. At the end of February, the US and Israel launched airstrikes against Iran, the Strait of Hormuz was blockaded, oil prices soared, and inflation surged from around the 2% target range, all the way to 3.8%. This completely disrupted Brooks' script. How can you cut rates by 100 basis points in the face of 3.8% inflation? The market will not agree, Fed members will not agree, and even the new chair himself might lack confidence. The latest data from CME FedWatch shows that the probability of a June rate cut is close to zero, and the probability of a rate cut this year is less than 10%. Brooks' 100 basis points have become a pipe dream. Wait a minute, remember that 0.7% I mentioned earlier? If the new chair successfully pushes for the use of trimmed mean PCE to replace core PCE, inflation will look like 2.3% instead of 3.0%. Then the path to rate cuts is clear again. At this point, Brooks' script might be reactivated in a revised version, so you see the entire logical loop. Trump chose the new chair because he wanted rate cuts. The new chair wants to cut rates, but inflation is too high to cut, so he might rationalize rate cuts by changing the inflation indicator. And if rate cuts actually happen, gold will be the most direct beneficiary. But if the situation in Iran does not ease, oil prices remain high, and inflation continues to rise, then no matter which thermometer you look at, rates cannot be cut. Gold will face a double squeeze of high interest rates and a strong dollar. All uncertainties converge at one point in time, this Thursday. The market will not wait forever. It needs a referee to blow the whistle. And this referee is not the new chair, not Waller, and not Trump. It is the data on Thursday, May 29. At 8:30 a.m. Eastern Time, 4 heavyweight data points will be released simultaneously. Core PCE for April, the second revision of Q1 GDP, durable goods orders, and initial jobless claims. This is the most intensive data bombardment this quarter for. Bombs exploding simultaneously. Why is this timing so critical? Because core PCE in March was 3.2% and CPI in April has already soared to 3.8%. If core PCE also rises, for example, to 3.4% or even 3.5%, it means that inflation is not temporarily pushed up by oil prices, but is truly spreading to consumption and service sectors. Waller's statement that inflation is broadening and becoming stickier will become a confirmed fact.